than the 0.5%. So that's gonna help us increase their purchase power, okay? Hopefully that all made sense.
Income-based what?
Income-based repayment plan, IBR, okay? And if I'm going too fast, slow me down, raise your hand, because obviously it's a lot of information, but I don't wanna spend a lot of time because it can get a little confusing. I just wanna really focus on the main important point. So that's an important one, because that's gonna affect how many more buyers we can help out and maximize their purchase power. Especially with FHA, we're always looking to push the limit on the DTI. Okay?
What was the name of that program again?
Income-based repayment, IBR, income-based repayment plan. Okay? So what happens with that income-based repayment plan, once they call Ellie Mae or whoever manages their student loans, they're gonna do a calculation based on their income, and that minimum payment on their student loans is typically gonna be less than if I would use 0.5%. Okay, 0.5% is good, that's an easy number, but if we can beat that, we might as well do it, okay? Non-occupying co-signers, I'm sure you guys are familiar with that we can add those in an emergency to increase the income if we're in a bind. That's still active. FHA has one of the highest debt to income ratios. That 56.999 is still into play. That's a high debt to income ratio. Some lenders out there, if you guys ever get a buyer that's qualified with Bank of America, Wells Fargo, Citibank, it's gonna be way lower. So just know, if you get a borrower who's FHA approved, there's always gonna be more wiggle room to go higher, okay, to 56.
The 580 FICO?
580 FICO. That's the minimum FICO. As far as underwriting, there's always gonna be more flexibility when you have borrowers with gaps of employment, spotty employment history. That's a big one, guys, with COVID.
Yep.
There's a lot of borrowers that I'm encountering that have that issue. I've personally tried to push them through conventional, and they're not going through. And I'm gonna talk about what's going on with conventional, and they end up going FHA. FHA still has flexibility when you have gaps of employment, kids who just came out of high school, they were not working for 6 months, and they had 2 or 3 different odd jobs, but they can piece together a 2-year history. Those complicated situations are perfect for FHA, okay? Riverside County, the maximum loan limit, $477,250. This here is very important, guys. 3 to 4 units debt servicing, okay? And I'm gonna quiz one of you right now. So, whenever you have a buyer or you're representing a seller and you're selling a 4-plex or a triplex, okay? It's very important for you guys to know, regardless of how much the buyer makes, the buyer can make $1 million a month. If the property itself does not debt service, the loan is not gonna go through, okay? So that's very, very important, okay? So what that means is that, let's say the property is generating $5,000 in gross rents, okay? It's a 4-plex, it's generating $5,000. 75% of the $5,000 has to be able to cover the mortgage payment. If it does not cover the mortgage payment, we're screwed. I don't care, you can get 10 co-signers or whatever, it doesn't matter.
Now, is that a reference to the 3 of the units, right? Like, is that how it goes? Because
Actually,
you have to live in one.
actually, they give you credit for all of them.
Oh, they do?
Yeah,
Okay.
all of them. If you're doing a triplex, they're giving you credit for 3, if it's a 4-plex, for 4.
Okay.
Okay, but even then, we run into issues.
Right.
Because a 4-plex, I don't know here, but in Orange County, a 4-plex is $1.5 million, $1.25 million. So the payment's gonna be $8,000 or $9,000, right? And then some of the rents aren't up to par, so that's an issue. So if you ever had that, remember that. This rule only applies to FHA. So if we're going conventional, throw everything I said out the window, because this rule does not apply to conventional. Okay, but conventional requires 25% down. That's the difference. Okay, very important. Okay, so VA. With VA actually has the highest debt to income ratio. You can go almost to 70%. I've done them up to 70% on the debt to income ratio. That's kind of crazy, but they allow it. Okay, VA allows a super high debt to income ratio. Why? Because it's proven that VA loans have the lowest default rate of all the loans out there, okay? Even though they're zero down and the high DTI, they have the lowest default rate. So the government still feels comfortable with letting the DTI be that high. Okay, so just know that. If you get a VA pre-approval, you can push it. You can push it to the max. Another thing that's very important for you guys, for both listing agents and buyer's agents, okay? A lot of listing agents, if you're working with a VA buyer, when they see that VA pre-approval, they automatically assume, not all but some, that the seller has to pay the VA non-allowables. And a lot of the times, that's a deterrent from that offer being accepted. Because the seller goes, oh, no, VA, forget it. I ain't gonna pay $2,000 or $3,000 of this guy's VA costs. Well, technically, yes. But the solution is that your lender, whoever they are, the lender can pay the VA non-allowables up to $3,000, $4,000, $5,000 as a lender credit. Okay? Was that you? Okay. So, when you're talking to your lenders, make sure that it gets addressed. In writing or a call, if you're the buyer's agent making that offer, hey, just know my lender's picking up the VA non-allowables. So let your seller know not to sweat it. Okay, our lender's gonna cover it. Okay, that's very, very important to know. Underwriting, even more flexible than FHA. Okay, you can get away with a lot of stuff on VA. They're super flexible, again, with credit, with deployment, all those issues. Manual underwriting is okay. So manual underwriting, that's when the loan officer runs the loan and he's not getting a DU approval. It's coming back refer eligible or refer ineligible or whatever, caution. Sometimes it comes back to refer caution. So if that's a case, if it's a low debt to income ratio, maybe the veteran has been on the job 10 years, he's got good assets, some reserves, even if he doesn't have a FICO score, and if there's something really funky, that'll qualify for manual underwriting. And they'll take into consideration compensating factors. What are compensating factors? Reserves, time on employment, okay? That type of stuff. Any questions so far on FHA or VA?
Can the lender
Yes, sir.
pay more than $3,000 or $4,000?
Absolutely.
More than allowable?
Absolutely, yeah. I think on average, in my experience, the VA non-allowables range from 1,500 all the way maybe to like 4,500. Unless you're getting into a purchase of like $1 million. I've got a pre-approval right now in Orange County. The purchase price is 1.250, and I'm doing the loan for 1.1 as a VA. So those non-allowables on that deal are like $5,500, and I'm covered. So conventional, 3% down is still available. Okay, so you can do 97% financing. DTI, 50% max on conventional. This is very important, guys. DU and LP are tightening up. Okay, so we're seeing this year that borrowers that we had pre-approved in 2019 were no longer getting a DU approval. Okay, because Fannie and Freddie have been tightening up. So make sure, if you guys have buyers you've been working with in your pipeline for months, make sure they get an updated DU approval. Because we've been getting surprises recently. Then what's happening is Fannie and Freddie have been tweaking the algorithm, that secret recipe that they have built into the computer, and making it harder to get the DU approvals. And even when you guys, if you guys listing agents or buyer's agents, make sure you're sticklers and you're asking for an updated DU approval. Okay, updated. Because this thing is changing constantly. And they're not making it easier, they're making it harder. Okay, very important. Non-occupying cosigners are okay, as well in conventional, we already talked about that. Manual underwriting, the same thing. So let's say you have one of those deals where you did not get the DU approved eligible. With New American Funding, we have a shot at submitting it as a manual underwriting. So if you guys are working with me, and I say, you know what, on this client, we're not getting a DU approved eligible, okay? I don't feel comfortable with giving you the pre-approval letter. Give me a week, I'm gonna run it through underwriting as an actual pre-flighted deal, run it through as a manual underwriting, and let's say what underwriting says, right? We're gonna submit income documentation, we're gonna do verifications of employment, the whole thing. It's gonna go through a formal underwriting, but under manual. Once we go through that process, if we get the approval, then I'll issue you not a pre-approval, but a full approval letter. Okay, so that's what I do as a loan officer. If I get a refer eligible, I'm not gonna shoot that client down. I'm gonna make the recommendation to do this process. Any questions about that? Okay, so this is important for you guys out here, especially with prices doing what they're doing out here. This question comes up a lot. I mean, at New American Funding, we have this, it's called OLA scenarios, where everybody puts in their scenario, what do I do with this loan, where do I take it? So Inland Empire comes up a lot. And the question out here is jumbo, they're asking for jumbo loans with 5% down or 10% down. Okay, the problem, and I'm gonna talk about it right now, with doing a jumbo loan with 5% down or 10% down, is it's doable, but the rates are really high. Okay, so the way you combat that is you do a combo. Okay, has anybody here done one of these or experienced one of these on their transactions? Okay, so these are easy to do, guys, and they're very effective and really good for buyers. So what you do a first mortgage to the maximum, which is $548,250, and then you do a second up to $500,000. So out here in the Inland Empire in San Bernardino County, Riverside, San Bernardino, you can technically go up to 1.165 with 10% down. Okay? 45% debt to income. Now on this program, you cannot use non-occupying cosigners. Okay? But this is huge right here, guys. Because on jumbo, that's the killer. On jumbo, you gotta show 12 months of reserves, plus your down payment, plus your closing costs. So on jumbo, sometimes that's the deal killer. Right here, that's huge. No reserves required. The second that we're doing behind the first is a line of credit. So that line of credit is adjustable, and it's interest only. Depending on the FICO score, the rate's gonna be like 5.5%. Okay, so 5.5%, and the calculation the borrower's gonna get is interest only. Obviously, the way things are going right now, the recommendation here would be you're gonna do 10% in 6 months or a year. We're gonna look at your situation, refinance, consolidate both into one loan. Okay. The minimum FICO is 680, which I think is pretty flexible. And you can actually do second homes. Now in this area, second homes obviously would be the Big Bear area, Big Bear, Lake Arrowhead. It has to be like a resort area.
Palm Springs.
So Palm Springs. So if you guys are running into second home buyers, it's a true second home, they can do this combination instead of doing a jumbo. Okay? So this is really important, and I think it's very valuable for you guys out here in this market. Any questions about that? I'm gonna start picking on you guys. Okay, so now we're gonna talk about non-QM. Has anybody here experienced a non-QM program? Non-QM? You have? Okay. Can I ask you what type of loan program it was?
One of my clients actually wanted to buy an auto body shop.
Okay.
And obviously, we had to think outside the box,
Okay.
and we had to get one of those loans in which the buyer had to put more down payment than originally was anticipating. We contemplated the thought of maybe a seller carryback, but we had to get creative, and that's what my buyer ended up getting.
So this is a really good program, guys. What I'm gonna, that example was obviously commercial, non-residential. I think you guys are gonna like what you're gonna see when I talk about this program. If nobody's really done verification on that. Okay, here we go. So the jumbo with 5% down, that's considered non-QM. Okay, and the reason it's considered non-QM, and I'm just gonna cut to the chase. Look at the rates. They're in the low 6s. Okay, but it's doable. It's doable. So it has to be primary, only up to $3 million, 720 FICO, full doc, W-2s, pay stubs, tax returns. There's no PMI, but it's one loan to 95%. Okay, so it is available for the right borrower. So if your loan amount is $3 million, you can probably do a purchase price of like 3.250, technically with 5% down. Okay, that's aggressive. That's aggressive, but that's why the rate is the way it is. Okay, that's non-QM. Okay, here's another type of non-QM. I did a lot of these during COVID, guys. So what happened was during COVID, the majority of investors shut down non-QM. Why? Because they were scared. What's going to happen with the market? These are risky loans. If we do them, who are we going to sell them to? So the majority of the market stopped non-QM. At New American Funding, because it's our own proprietary portfolio program, we continued. So I was pushing this really hard during COVID, okay? So this is a bank statement program. The big thing here, guys, no tax returns. Okay, so there's no tax returns required. You can do it on primary, second home, investment property. So what we're doing right here is we're qualifying the buyer based on their monthly deposits into either their personal bank statements or their business bank statements. So I'm asking for 12 months worth of bank statements. And what I'm looking at, when I've got all their bank statements laid out, how much are these people averaging per month in deposits? Okay, 7,000, 10,000, 30,000, I come up with an average. That's their income. Whatever that average is, that's their monthly income. Okay, so if they're self-employed, even if their tax return shows 0, we don't care, because we're looking at their true picture, which is the bank statements. So that's gonna show income, okay? So on this program, I don't know if you wanna have it here, but yeah, 10% down. So they have to come in with 10% down, and they have to be self-employed. Okay, so that's the kicker. Self-employed, 10% down, 12 months bank statements. Rates aren't bad. Depending on the FICO, if they've got a really good FICO, 720, 740 or higher, they're gonna be in the 4s. But this program requires a 700 FICO.
No PMI?
No PMI. Yes,
For
ma'am.
self-employed, they need to be self-employed for 2 years or
2
that-
years.
2 years, right?
Good question, good question. 2-year self-employment. Okay, so keep this in mind, guys. I know you guys know a lot of self-employed borrowers. People get turned down left and right every day because they don't show their income on their tax return.
You still gotta supply the P&Ls, right?
But it's super easy.
Okay.
At least with us, sometimes I actually help them with the P&Ls. So I'll send them a template, and it's really basic and it's nothing illegal. So all we're doing is very easy. I'm looking at their tax return, if they're incorporated or if they're Schedule C. And on their Schedule C, you have a P&L, and it tells you what the costs are. So all you do is you take a Word document, and you take the expenses they're showing on their Schedule C, maintenance, gas, vehicle, all that stuff. You put that on the Word document, listo.
Okay.
Easy. Okay? Good question. Any other questions about this program? Okay. Norma, ¿tú una idea ahí? Okay, so this is really cool too. So this one is pretty new to the market. So this is for investment properties only. So this is for your investor clients. No doc. Okay? No employment. No income docs. Okay? Kind of like the old days. But 20% down is required. Property must be investment. What's the other kicker here? Oh, here's the kicker. Mortgage payment must equal the market rent per the appraisal. Okay, if the client is putting 20% down or more, that should not be a problem. The payment's gonna be right in line. If, in most cases, I think you guys would agree, there's even gonna be some cash flow after the mortgage payment is covered, right? Would you guys agree? If your client is putting 20, 25, 30% down, there's gonna be some wiggle room there. So that's the only rule we technically have to watch out for. If they're doing 25% down, and they have a 700 FICO score, rent does not matter.
That's huge.
That's huge. Okay? Rates are on the low. I actually have 4 pre-approvals out there right now on this program. Okay? Rates are from the low 4s to the high 5s, depending on high FICO. This is huge too. This kills a lot of deals. LLCs. Obviously, you guys know investors want to purchase and sell and transact in the corporation name. A lot of lenders will say, no, we can't. You got to put it in your primary, then you can do the switch, and people don't want to mess around with that, right? LLCs are okay. Okay? So take your notes on this one. This is a really good one.
Frank,
Yes,
how
sir.
many points do you charge and for investment property?
It depends on the FICO, but I think I'm gonna tell you, on average, 1 point or less.
Oh, okay. They're gonna happen because all the time happen.
Of course, of course. But it's not like hard money,
Okay.
it's not private money, this is non-QM. So this is like right in the middle, you have A paper, non-QM, hard money. This is right in the middle.
What's the loan limit?
What's that?
Loan limit?
You know what, this one goes up to like 3 million as well. Yeah, so there's a lot of flexibility. Why? Because you're coming in with 20% down.
Are they able to sell right away?
This
If
one,
they wanted to sell?
good question. This one does come with a 1-year prepay, okay? But they can buy it out.
And what does that mean?
So what that means is, so this program, the way it's structured, it comes with a 1-year prepayment penalty. And what that means is, if they sell before a year, the bank is gonna charge them 6 months worth of interest. If they wanna avoid that penalty,
Wait a year.
they can take a higher rate. They can take a higher rate, and then they can flip it if they want.
Okay.
Okay, good question, good question. Any other questions, guys? Okay, we'll move on here. Okay, whoops.
Click on it.
A ver, Hugo.
Technical difficulty.
Man, I was in the groove, right? Okay, 2 back. Right there. No, there you go. So this is just a traditional jumbo. So this is for your A paper jumbo borrower, okay? So look at that. Rates are right now in the high 2s on jumbo. That's crazy. Okay, we haven't seen that in a long ass time, okay? Normally, jumbo rates are higher than conforming. Right now, they're in the high 2s. But this is A paper, okay? Clean cut, full doc, 700 FICO and above, good reserves, okay? We have 12 different investors in-house. So we dock those in-house, we fund them in-house, we do everything in-house. The underwriting is strict, the debt to income ratio, but it is available. This one requires 20% down. Okay, so that's for your, again, cookie cutter borrower out here in the Inland Empire, that's what you can expect.
The loan limit?
Well, it's jumbo, you can go up to 6 million.
6 million?
Yeah. Any questions about that one? Okay, so on this one, I'll give you a heads up. So if you guys do come across this type of borrower, a lot of the times, they're gonna be pre-approved or have some information from their bank, whoever they bank with. Whether it's Citibank, Bank of America, Wells Fargo, Chase, they're gonna have their guy. But as we all know, how long is that transaction gonna take? Okay, so just keep that in mind, that there are really good rates, really good in jumbo investors, and we can knock these out in 30 days. Okay, cause it's done in-house.
Frank,
Yes, sir.
there is any chance to get that information via email?
Absolutely, so we have a bowl out there. Tiffany, if you can do me a favor and pass it around to make sure we have everybody's card.
Sure.
And then I will email everybody this presentation.
Perfect, thank you.
Okay, out-of-state loans. So this is also very important, guys. I could actually help you guys with referrals, with whatever you have in 49 states. Okay, I can do loans in 49 states except Hawaii. Okay, so we have a team of loan officers. The way we do this is this. So at New American Funding, we have a team of loan officers. I think there's like 10 or 12 loan officers. Each loan officer has 3 or 4 licenses. Okay, so between this team, they're licensed in 49 states. So if I get a referral from you guys, you have a client that wants to buy in Texas, no problem. I'm gonna structure the loan, I'm gonna pre-qualify them. Once you send me the contract, or whoever's doing the transaction, I make sure it's a real loan, transfer it to the multi-state team, they take it and run, I oversee the whole transaction, and we close the deal, okay? But I'm still your primary contact, I'm still involved in the transaction, okay? That's huge, 49 states. That way you guys aren't like in, I don't know, in outer space, not knowing where your loan's gonna go or your referral, I'll still be overseeing it, okay? And there's my contact information. And I think you guys have all my cards there.
Yes.
Follow me on Facebook. I do a lot of singing on Facebook.
Sing, Frank.
Some weights once in a while. Yeah, but any final questions on anything? I know I went fast. Yes, sir.
You don't do land, so.
No. My recommendation for land loans is US Bank. The other one is that we didn't talk about much, I-10, okay, I-10 loans. My recommendation for, even though we offer them, I'll be honest with you, but it's a brokered out loan, okay, which I'm not a big fan of, okay? I'm not a big fan of because the rates are high and they charge 2 or 3 points. So I'm not a big fan of pushing that loan, okay? And that's the loan that most lenders out there have access to. Because there's only 1 or 2 investors in the whole country that have the I-10 program. It's First National Bank of America and it's Green Box Loan. Every lender has the same ones. The one I would recommend, which I don't make a penny on, is Self-Help Credit Union.
Yeah, that one is good.
Write that down. Self-Help Credit Union. They have the best program. I can't say too much about their service.
Just get it done.
Yes.
But they've got the best program.
Yeah.
They really do. I mean, we tried. The president of our company met with the president of Self-Help Credit Union. I was excited. We were gonna form a partnership. And I sent an email to all of our loan officers. We sent them like 50 loans. I didn't get a response, statuses, un cochinero. And that was the end of it. Unfortunately. So, but again, I want to talk about it because it is a good program. What I tell my realtors, I've sent a lot of realtors there. I said, just be prepared to be a loan officer or like a loan processor, because you're going to have to really be involved in the documentation, make sure they got it, all that. But it's a good program. It's a good, yeah. Yes.
Do you do manufactured homes?
Yes, we do. Both FHA and conventional.
Okay.
Yeah.
On the San Bernardino County, at the FHA, what is that loan?
477 250. Yeah, same as Riverside. Final questions, guys? Comment about loans, transactions, problems you've had, any scenarios?
I do have some loans that I will send. Do I send them to you or to your team?
Absolutely. Just email me directly. Yeah.
Yes.
Okay. Anybody else? Señor Méndez, ¿alguna pregunta? En español también se vale.
I'm good.
Good? Okay. Yeah, Francisco.
There is any forms that I need to ask my buyers to sign for you to run their credit or to do,
Yeah,
to
basically.
start the process?
Yeah,
with
the
you?
way that I do that on pre-approvals is we're okay with getting a verbal confirmation. So whoever here, if you send me a client to my team or myself directly, I'll call the client immediately, have a conversation with them over the phone, and then at that point, I get the verbal authorization to run the credit. And then once the borrower sends me the documentation, I send them to this young lady back here, and then she creates the file in her system, and then she's the one running the credit. Once she's done with that, she sends it back to me, I review the credit, call the borrower, give them the option, and we're off and running.
Awesome, that's great.
So I have
Thank you.
another question.
Sure.
When you have a client, because mostly
with all those type of issues that we have right now, some people, the credit is not too good. So you guys, when we send a lead and, you guys run the credit, talk to them, did you let them know you cannot qualify right now? Or they give you options to help them to increase the credit? Are you guys work with that or?
Good question. So here's the way that I handle that. So when I run someone's credit, I obviously review it with them. And then if it's something that I feel I can help them with, then I personally coach them on what to do. I'll say, you know what, you need to pay this credit card down to this amount, you gotta pay this one, you have to add yourself to your husband's credit card to increase. That's to get us maybe 20, 30, 40 points. Let's say I run it and it's a 580 and we need to get to a 620, so I'll coach them on that for free, easy. But if it's heavy lifting, where they're like at a 500 or 520, then we refer them to a credit repair company. I have a it's hard to recommend credit repair companies.
Yeah.
I have one that I put my name on it. I've known them for 21 years. And they've helped me with my credit twice in 21 years. They're not cheap, but they work. And I would not recommend them if I wouldn't trust them. Okay, so any clients you guys would send me, I would refer them to them. And with my clients, I mean, I've been doing this a long time. I like to be very clear and very direct. Okay, here's the roadmap. Here's what you need to do. It's pretty black and white.
Thank you.
Do you do rapid rescores?
We do. So that's the kind of stuff that I would work on. Again, I would have the borrower pay down XYZ credit card, do this, call your creditor, get me a letter. Once I get the letter, I'll do the rapid rescore. That's exactly what it is. Any other questions? Yeah.
Silly question, but if we send somebody to you and they need some work done and maybe, 8 months down the line, they should be ready. We can assure that you'll send them right back to us and not to your wife who's a real estate agent or somebody else. I'm not saying you personally, I appreciate it.
Asking for a friend?
Asking for a friend.
So what we do, and that's a good question, that's a valid question. So what we do is we also have our own CRM.
Got it.
Okay, so we put the lead in our CRM and we attach a source code to it. Okay, and the lady who manages that CRM is right there, and she's very good at putting the source code, who referred it, and then keeping that borrower and realtor in the loop. Yeah, I mean, and all I focus on and what we do at New American Funding is strictly loans. So we don't do real estate. Yeah.
Do you have courses, sir?
Do I have horses? No, but I'm looking. Do you have some for sale? All right, well, thank you very much, guys. I'm hoping that you guys took some value from here. If you have any scenarios, feel free to email me or text me or call me anytime. Thank you so much. Oh, and before I forget, we have a raffle for a bottle of tequila. You want to grab the bottle, Hugo?
The first one?
All right, so. It's a good bottle, guys.
Yeah.
Okay.
All right, here we go, right here.
I quit drinking.
Yeah, right.
Hey, Naeem, that gets open at my house.
I'm gonna play the
Look at that.
lotto today.
Vamos a tomar.
Thank you, thank you.
You guys, we thank you guys for coming again, and if you guys
Thank you.
need absolutely anything.
You're over 21, right?
Reach out, text, call, email.
Thank you for the invite.
Hopefully you guys picked up some good stuff. Okay. Hey,
Oh, you're welcome.
Thank you for coming.
Oh, perfect. Okay.
Are you?